My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Going to the Fed meeting, let's talk about what we've lost. The groups that are no longer working, the ones that need to turn around if we're ever going to get a sustainable rally and out of this miserable period. These stocks are former leaders that have been taken out and shot. Sell. Just shot endlessly. Even as their fundamentals are often in tremendous shape. Not good shape. Not great shape. Fabulous shape. After captivating the market for ages, they've become millstones around the necks of investors everywhere. And that's how you end up with a situation where you had a day like today, kind of a somber day, not a day of real interest, not a special day. Dow up 67 points, S&P gaining 0.48%, NASDAQ inching up 0.22%. And it actually counts as a tremendous session, a huge win for the bulls. That's where we are now. The first group of dethroned leaders, let's just rip right through them. The meme stocks. I say this because these people stick by me through thick and thin, and I love them. I regard myself as the leader of the meme team. Not. All right. These were exciting as long as they lasted. I mean, a little less than a year ago, Amc Entertainment was a $63 stock. Now it's a $15 stock. Still a victory versus where it traded at the beginning of the pandemic. But unless you got in early, this one's crushed you. That's what I was trying to help by telling people maybe at the 60 level wasn't so good. But I should have kept my mouth shut. The next meme name, GameStop. Powerful backer, Chairman Ryan Cohen. But the problem here is that the market perceives that the gaming cycle seems to be winding down. Availability has become much easier for all sorts of consoles, and most people would rather buy their games over the internet. I went to the website today to see what the top brands were. Well, the website didn't really work. I get that. Anyway, throughout the GameStop frenzy, the stock had a legitimate prop. The new hardware was flying off the shelves, and you couldn't find a PlayStation 5 for love or money. But now they're plentiful, and that means there's much less reason for anyone to show up at a GameStop. Memo to those who dislike me for saying this, I suggested you go take a classified ad out in a newspaper because Jimmy Chill is done with your moronic, scatological tweets and hopes you never come back from your permanent intellectual vacation. The other meme names never had longevity. AMC, GameStop. The Reddit crew loved that Corsair Gaming. That got cut in half. They tried to run and gun Wendy's, but it shed 6 right at their... It threw a Baconator right in their faces. In the end, it came down to AMC and GameStop. They were a 2-stock club with the collapse of Robinhood's stock, making for, I think, let's call it a fitting coda. Guys, enjoy talking to yourselves. No one else is ever going to listen. Then there's housing. Now, we thought we had something going with this as a leadership group. Oh, I love them, right? Because a lot of stuff goes into housing, punches above its weight. But the home builder stocks, not the companies, the stocks, have been crushed as mortgage rates have risen to 5.5%. Here's what you need to know. While these stocks might look cheap, as though they're trading right now 4 or 5 times earnings, that's most likely because the earnings estimates need to come down, perhaps gigantically. Housing affordability is the worst it's ever been. That's bad. They can't like that. In the first quarter, well, let's say you got double-digit price appreciation in 70% of the metro markets in America. 70. The median single-family home price has risen nearly 16% year-over-year, up to $368,000, according to the National Association of Realtors. That is just way too hot. That's smoking hot. That's not acceptable. The Fed will have to crush these figures because housing inflation is devastating. And look, even though the home building stocks have been gutted, I doubt they fully reflect that's how bad things can get. The best housing analyst firm I know is Zelman Associates. So I went to Alan Ratner. He's one of their associates, and he pointed me toward book value data, which show conclusively that price-to-book value models tend to trough at the end of a rate cycle, not anywhere near before then. We're at the very beginning. Some housing stocks continue to fall even after the tightening cycle was over. Radner also mentioned that on the average, home builders saw their price earnings multiples shrink by 27% from the beginning of the tightening cycle to the end. There could be some intermittent rallies during these periods, but they all end up badly unless the Fed stops raising rates. That's exactly what you'd expect. Who wants housing exposure when mortgage rates are on the rise? In a quarter where the Fed announces a rate hike, the home builders have underperformed the S&P 500 69% of the time. Finally, don't trust anything that trades at 4 to 5 times earnings. That's called a value trap, all right? So, housing stocks. Oh, I forgot. That's because I'm friends with the mean people. Next, how about the financials? We made a stab at owning the banks earlier this year for the charitable trust. These stocks soared in January when Wall Street thought the Fed could raise interest rates ever so gently without scaring the consumer. That assumption is going out the window as investors increasingly feel that we're headed for a hard landing. We should have sold every single one of them. In a hard landing, the banks get stuck with lots of bad loans that offset the easy gains they make from your deposits. Banks had a relief rally today. That's all it was. By the way, I continue to think that the consumer is so strong that I won't have to worry about it. But minority. Fourth, the software as a service or software as a whatever stocks spent years soaring into the stratosphere, fueled by their fabulous revenue growth. But when the Fed declared war on inflation last November, this whole group got crushed. In a way, the endless cloud IPOs and SPAC stocks were the most inflated part of the economy, and they crushed the market in the end. Hey, you know, FANG fizzled too. It wasn't just because of Netflix. It's also because of Amazon. It's also because of Google. Also because of Facebook. That's pretty much every letter. Netflix had the single worst quarter of the majors, and it dragged down every other company that was trying to do streaming or gaming. That's not done. It's still doing it. Google, what a stench. Google's coming back because people realized there was more to the quarter than YouTube's weakness in Central Europe. But I'm astounded how terrible that Amazon quarter was. I read it over again last night. I said, I'll just read it over. Maybe I missed something. No. Hey, Meta Facebook's finally putting up some decent set of numbers, but that's after the stock plummeted back to pre-pandemic levels. I do think that at this time next year we'll say, what was TikTok? Maybe a communist Chinese invention because we have reels. FANG, my favorite acronym, it died. It died this quarter. Hey, I used to write obituaries for a living. I know when something's dead. Oh, we used to have the semis. Remember the semis? They were great leaders, with NVIDIA being the greatest of all time and AMD coming in a close second. But they, too, have been crushed by the decline of gaming, even as no one in the video game industry even thinks that that's the case. Now, I wouldn't believe it either, except Microsoft did say it was down high single digits. Who wants to disagree with Microsoft? Now, I saw AMD's numbers tonight, and I love them. But there are so many naysayers out there, who knows if they will stop selling even on great numbers. Perhaps the most horrendous fall of all was e-commerce hitting saturation. It wasn't all Amazon. The great e-commerce deceleration has hurt everybody from the box makers to FedEx, UPS. We know that Shopify is down nearly 75% from its highs during this period. Etsy's struggling to find its old self. They just aren't liked anymore. Hey, same thing goes for the adjacent fintech names like Square, Affirm. Don't look at Affirm. No matter what you do, do not look at Affirm. Finally, the IPOs and SPAC stocks did us in. Even though there's been a 71% drop-off in SPAC issuance to begin 2022, these new deals sopped up a lot of capital that's now being drowned in the toasts and lemonades. And by the way, that's not toast, except toast is toast, but that's not toast and that's not lemonade, okay? Those are companies. And, Unity Software, which actually I kind of like long-term. Roblox, I like them too. Doesn't matter. Just IPO roadkill, plain and simple. Some of these are genuinely good companies, but their stocks are totally toxic. Did these fallen IPO and SPAC names slay the bull? No, they were just the wretched excesses of an already bygone era that we wish the Fed had stopped, but it was kind of helpless to do so. It had to be the SEC and the brokers, and they never did it. Now, anyone who watched me this morning knows that I am sick and tired of the critics who keep trying to belittle or humiliate Jay Powell, the Fed chief, who will be on TV tomorrow, who arguably did more to save us from a pandemic-induced depression than anyone else in the government. They act like Powell should have known Omicron wouldn't require a lockdown. We'll tell that to communist China. Apparently, they didn't get the memo. But here's the bottom line. Jay Powell measures his words. He wants to take the air out of everything I just mentioned, okay? And guess what? If you look at the stock market, sadly for the bulls, but perhaps good for the economy and the country, he's winning. Frank in California. Frank. Frank?
Yes, can you hear me?
You're up. Yeah, I hear you pretty good, even though my right ear's completely clogged because I flew with a cold. What's up?
Oh, hey, so I'm a first-time caller, and I'm calling about Roku. And I bought in at 63. I bought in again at 83. I watched it go up to 490 or so, come back down. I think it's sitting at 100 now.
103, yeah.
And I wanted to know, I know Anthony Woods and his team are very positive on the stock, but I wanted your opinion. Is it time to get out, or should I hold on?
You know what? This is one of those names. It's got hurt because it's also owned by Kathy Wood, or she's viewed as her company. You know what? Look, I think it's 6 or 8 dozen or another. I mean, it could go up 10, it could go down 10. There's absolutely no edge to owning Roku right now because it has to do with streaming, and people don't trust streaming. Let's go to Brett in Texas, please. Brett.
Hey, booyah, Jim.
Booyah.
Hey, my stock reports on the 17th of May and is expensive at 70 times earnings. With many high multiple stocks getting punished this quarter, even after reporting solid earnings, is Palo Alto a buy into earnings?
Well, it's the only segment left of this economy that has tremendous demand simply because there's so many bad guys. There's just, I mean, it is an incredible business because the enemy is just so everywhere. And that's why I like Palo Alto. And I'm willing to pay up only for cybersecurity companies, because the people who want to get into our machines and into our heads and our everything else are relentless and very smart. Stephanie in Massachusetts. Stephanie.
Booyah, Jim.
Booyah, Stephanie.
First-time caller. I've loved your show for the past 12 years.
Wow. Thank you.
Currently sells for 21 times earnings and has a 2.5% yield. It just recently launched breakfast in Canada. However, rising inflation is affecting the fast food industry, and my stock hit a new 52-week low today. Going into earnings next week, what are your thoughts on Wendy's?
I think Wendy's ranks after McDonald's and Chipotle of the ones I want to own. I think it's good. I think Chipotle's great. I think McDonald's is so loved by institutions that they just won't sell it no matter what happens. It's one of the few stocks that are completely seem to be immune from selling. And for that, I frankly don't know why. Jay Powell measures his words. He wants to take the air out of everything I just mentioned. And guess what? If you look at the stock market, he's winning. This is our group that we need saved. If that group can hold the line, maybe others will too. On Mad Money tonight, Logitech hit a fresh 52-week low today. So does this tech play have what it takes to connect with investors once again? I'm checking in with the CEO. Then Rockwell Automation plummeted today after earnings. I'm running through the numbers with the company's top brass, and it is worrisome. Then Airbnb reported after the bell. So does the home rental kingpin deserve a home in your portfolio? I like the numbers. Don't miss my exclusive. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.